Welcome back to the Compass. Um, with you as always, my name is Derek McPherson. I'm the executive chairman of Olive Resource Capital. And of course, we have Sam Pelez, president, CEO, CIO, and chief cook and bottle washer at Olive as well. Actually, we don't let him cook. It's not safe for anyone. But we're back. It's Friday, November 14th. Lots going on in the world and in markets. Including the government shutdown ending. Gold seems to have recovered off its lows, but back down again a little bit this morning. Lots of vol in the macro world. Sam got out of the house this week and went to the Precious Metals Summit. And obviously we are right at the end of Q3 2025 reporting. So lots to talk about as far as what's going on in markets and where we're at. Maybe let's touch on what we're seeing in the broader markets for Sam and what we think's going on.
I think this is a good time to do a little bit of a review of what's going on in the macro world. By no measure do we consider ourselves experts on the macro, but certainly something that we keep an eye out for on a day-to-day basis. And there's been quite a fair bit of volatility over the past week or two. And I think it's important for us to touch on it because our views has been that global liquidity continues to be at all-time highs, and that's the major underpinning for both the broader global markets, but more importantly for the risk on trade of commodities, regardless of the seasonality that we've discussed a few times on this show. But I think this is a good time to talk about it. And in spite of the volatility and some of the markets kind of coming off, global liquidity continues to be at all-time highs. The Chinese central bank, the PBOC, continues to inject liquidity into their system. We've heard comments from the New York Fed, where they had discussed the plans to inject substantial liquidity into the markets in the U.S. During Q1 2026. That all assisted by the government shutdown ending, which naturally will release whatever capital has been trapped in the system in the treasury over these month and a half, or just over a month. So I think there's positive momentum on that global liquidity curve. Now, having said that, some of the markets are off, and that's a little bit interesting because the slew of news that we've heard this week all just appear to me, and this is a personal opinion, that it's the kind of headline news that shakes the tree, forces people to sell, i.e., for example, famous Michael Burry texting that he was short Palantir, and he actually didn't text this. This actually came out in government reporting, but he was short Palantir via puts. That kind of creates some instability in the market. But then that fall was followed immediately by a credit rating agency lowering the risk profile and the risk rating for Oracle debt. And this is obviously very important because it's part of this big major AI infrastructure development where a substantial amount of the cash flows for all these Mag 7 companies is being directed to. So, a sequence and a slew of negative headlines in spite of increasing global liquidity has taken what seems to be like the market just off the top and create a little bit of fear. Now, to me, it just doesn't feel like the headlines have enough meat on them, and that the global liquidity will continue to support the market. Now, loose hands will exit the market. I think that's what some of these headlines are created for. But ultimately, I think the underlying trend is continues to be bullish for the commodity markets. And we're positive as we go into Q1. We've said many times Q4 tends to be the most volatile part of the market. But as we come towards the second half of November, beginning of December, that's typically a good point to start getting more aggressive as we load up for Q1.
Yeah, I mean, the funny part on the Michael Burry comment is I think just yesterday he announced he's closing his fund as well. So, short Palantir and closing his fund. So somewhere in between. Something about not being able to understand valuations in the current market, which may say something in and of itself. The other thing that I think is interesting, and it's very similar to what we saw in gold over the last kind of 3 weeks, right? You had this month where you had this kind of pullback and it shook the tree, right? And it shook out for the most part, it shook out a lot of loose hands. And now we've kind of everyone said, okay, now we're here, we're rebuilding and coming back. And so I think that was, as you look over the commodities, that's interesting. I guess one thing I want to follow up on, and you mentioned Oracle and the AI capex, a little bit of the AI capex cycle. They're like, I don't, a lot of people don't quite grasp, I think, like how much copper and kind of energy type commodities are going to be needed to actually make that AI work. And not because you need it for the chips, but because you need it for to generate the power to power the chips. Now, advances are reducing the power requirements, etc. But there's going to be a lot of power required, and I think that is something that is going to drive, particularly the copper market, sort of longer term, even if we do have a slowdown in the short term. And so I think that's something that is important, and we've kind of reached you mentioned the cash flows and the Oracle thing, and that this part of the AI capex cycle that's going on. There's very few companies actually benefiting from the AI capex cycle right now. I think that's an interesting point, right? You really just have like NVIDIA and the other chip makers kind of benefiting from it, not it's not a broad base. You're not seeing copper producers or power companies or other kind of that broader area that needs to benefit. But it was an interesting point, and I listening to as part of my job, I listen to macro people who actually know what they're talking about. Macro talk about it. And one of the things that was interesting was what they said is, for the most part, you mentioned this, right? The Mag 7, they've been funding a lot of that AI out of their cash flow, right? They're generating sufficient cash flow that they can fund it. Well, Oracle, who kind of been singled out, which isn't part of the Mag 7, it funded its piece with debt. Its AI build out with debt, and I think that's where it becomes interesting. And if the AI capex cycle slows down, and there's a gap between the financial benefits of AI and the build out of AI, these companies that are taking on debt, that's where you create financial risk in the system, and that could be what bursts this bubble is kind of being inflated. Whether that happens or not, who knows? But that's something that got flagged to me by somebody smarter than me, and so something that I'm watching.
Yeah, so at the risk of going too deep into the rabbit hole, so OpenAI has mentioned finally that they plan to go public in 2026. So you'll see every effort to keep the market in place and intact, at least until that happens, and people are able to exit on that secondary. The big funders of OpenAI, they've also admitted that they're going to need substantial amounts of cash over the next 12 months. And I think that's what's happened with Oracle and all of these companies. I think the reality is coming home in the sense that they've committed to these major projects. I mean, some people estimate that just to be at the level that China is at, the US needs to build at least 350 gigawatts of power dedicated to AI affiliated industry. For those who are not familiar, that's 50 nuclear power plants or 300 gas power plants. Like, it's a lot. And that'll come at a cost of somewhere between, 1 billion per gigawatt to 2 billion per gigawatt. So we're talking about $1 trillion investment cycle just for the power. Think about grids, associated infrastructure, the actual NVIDIA chips. And I think it's coming home to roost the idea that this Mag 7 companies have walked into a pretty substantial development cycle that will eventually need some type of government intervention. If you go back to all the big developments, the highways were built with government intervention or government support in the 50s in the US. This will require, and we were talking about this before this recording, and in the good sense, this will require some sort of bailout from the government. And we were already starting to see some elements of that. 2 weeks ago, we had the announcement by Brookfield and Cameco, the joint owners of Westinghouse, together with the US government, a pretty substantial commitment for development of nuclear facilities in the US. So that's, in my view, round one, which will be followed by many other rounds. Now, what does this mean for us in the commodity cycle? Excellent news. These are all real assets. They need concrete, steel, copper, and more importantly, dollars, which means the U.S. government is going to have to continue to engage in injecting liquidity into the global economy, which will ultimately should be, as it has been, should be very good for gold. Who would have thought so? Like maybe AI is actually the tipping point for the next bull market in the commodity cycle.
In the broader commodity cycle, yeah, absolutely. But the broader commodities haven't really seen that. Started to see moves, but haven't really seen them yet. Copper's doing okay, but I think that's more supply subtraction driven. But I mentioned you got out of the house. You went to the precious metals summit in Zurich, so not that far out of the house. But maybe mood, what you thought of the conference, feedback. Give us a flavor of what you saw there.
Yeah, so I think the biggest change year on year for this conference, and we also saw this in Colorado, is much higher attendance, greater levels of interest. In this case, we had Pierre Lassonde, Frank Giustra, my favorite newsletter writer was Marc Faber. They were all together presenting, and I think the one thing they all share, which is something that we love to talk about, is I've seen this movie before, and the chessboard is set up, and they all agree in such a way where the appeal for the commodities over the next decade, there cannot be a better setup for commodities over the next decade. In particular, all of them are bullish on gold. Marc Faber believes that gold is at a pretty decent price, and maybe some catch up from other precious metals is necessary before it can continue. But regardless, all of the pieces are in place today for this cycle to continue, and for effectively the global currency debasement to continue. Now, that doesn't mean we're going to lose fiat currencies in the next 5 years. Doesn't mean they're going to zero. I think it's just like a continuation of what's happened over the past few decades, except with the fact that this fiat currency devaluation doesn't move in a predictable way. It has waves of when there's quicker devaluation, and there's other times when there's kind of like a more gradual and slower devaluation. I think we're pretty self-evidently, just by looking at markets, you can see that we have entered one of those periods of fast deterioration of the purchasing power. And frankly, the only escape for an investor or a saver is to allocate their dollars and their fiat currencies to real assets, whether they're in commodity-related businesses or in commodities directly or other real assets. But that those should be the sectors that outperform over the next decade.
Yeah, I think that's a great takeaway from those. I guess, for lack of a better description, the gray hair in our industry. Although you and I are not looking quite as young as we used to when we started. But I think that's it's something that we all see. But when you have guys like that talk about having seen it before and the things that have come, it gives you confidence that, hey, we're on the right track as far as what we're doing and how we're approaching things. And so I think that's very interesting. What about any companies or anything like that you saw that you don't have to say specifically, but any kind of maybe not specific companies, but themes that you saw that were interesting?
I think this was a continuation of the theme that we discussed at the Precious Metal Summit when we filmed there, which is, for the first time in a very long time, we have exploration companies and junior developers that have access to abundant cash. What that's going to translate to in many, not in every case, but in many cases, is people who have a discovery are going to show up next year with 3 million ounces and a real project that today may be valued at 100 million, but once you prove in the 3 million ounces, it could be worth 500 million.
Right.
I think we're about to see a few of those, and perhaps even if you go further down on the exploration space, maybe by next year we have a few new discoveries of great interest. We've talked here about the Prospector drill hole that came out about a month ago. We're going to talk about Prospector more in a second, but we're finally back into this era where there's excitement in looking at these companies. They're fun, that they can actually do genuine work, and we're going to have new stories, and that's always exciting. So I guess to directly answer your question, I saw a few companies that belong in this category of, I can see this company using the money they already have on the balance sheet today to multiply their market cap between now and next year, just by executing the work. A lot of them have already met the threshold of, kind of overcome the threshold of geological risk. They've already drilled the structures. We sort of have an idea of what the structures look like. Now it's all about turning them into technically competent resource. That you can kind of like link the valuation to.
It's funny what good companies in the downturn, what they do, and I think Prospector was a good example of this. It's something that we did at West Point. It's what you do in the downturn is do all the things that you can do to make your targets really viable, right? So some of these companies that have kind of, really put the work in the downturn of like the field work and the sampling and the mapping and the geophysics and the, maybe scout drill holes or small programs to figure things out. Those are the ones that you go, okay, now that all of a sudden when they have money to go drill something off, if they've got the goods, if all that evidence points to it and they get the goods, you're going to get discoveries. And I think that's something that I think is worth from our perspective and how we look at things is like, okay, it's part of the reason we, it was always a small position in Prospector, but we always kept it there because we knew that there, smart people doing smart things. And so I think it's definitely something that we are conscious of with these companies and then this cycle. And then I think you also got to watch the flip side of that is misallocation of capital. But that's a a whole episode in and of itself as we get deeper into the cycle. You get these fly by night new companies that aren't doing good work, but they're, because they have money and need to drill, they got to drill right away. Right. So I think that's another aspect, but maybe I think that's a good segue into kind of gold stabilized. Basically it's up a little bit. Precious Metal Summit, smart people and people who've been around and seen this cycle before saying that we need to do this again. I think the other thing that jumped out at me in the last week and the last couple of weeks has been the Q3 reporting. Not that the production numbers were spectacular or the cash cost numbers are spectacular by any stretch of the imagination, which are kind of the things the individual companies control. But the headline numbers from a revenue and cash flow and EBITDA perspective are all, if you're not putting up record highs in cash flow, revenue, and EBITDA, I don't know what, you're doing it wrong as a producer, I think, right now.
Yeah, but the good companies do translate the favorable environment into enormous amounts of cash. And I'd like to talk about Anglo Ashanti. We've talked about it on this show multiple times. If you think about when we first got invested into this company, it was making about $300 million of mine operating cash flow per quarter, which is a lot, 300 million. Now, gold prices have doubled, but the cash flow has not doubled. The cash flow has gone to 1.4 billion a quarter. That's more than 4 times what they were making when we got involved in the story. Now, there is the Centamin acquisition in there, but I want to say, I don't have knowledge of it, but I want to say Centamin is probably like 20% of the production. So maybe this, you adjust for that, it's gone up 4-fold when the gold price has doubled. That's the reason why you would invest in a gold producer, one that can deliver exactly that, the margin expansion and maintain it. And just to put it in context of how extraordinary the results for this company are, they made 1.4 billion in Q3 from mine operating cash flow. Agnico Eagle made 1.8, which is spectacular. The margins at Agnico are amongst the best in the Western world. And these guys are, 20-25% off that number. This is a pretty impressive operating company. By the way, it's only trading at half the valuation of Agnico. Not that I'm suggesting it will trade up to the valuation of Agnico, but it certainly has more room to grow. But also, just and I think this is where you want to go after this, is what this has translated into is a company that now has no net debt, a company that has been able to increase the dividend. In this case, they have not started buying back shares. I still think they should put a policy in place just to have it in place. You never know. Like volatile markets like 2 weeks ago or 3 weeks ago happen and you can take an opportunity to buy stock. like some guys that only resource capital bought back stock. And they're just like the pristine balance sheet and that they have right now has set them up for, they've adjusted the Centamin acquisition. Now they're set up to effectively to whatever, like they can buy more assets. They can just go all in on the development of silicon, whatever it's called now. And, they're in a prime position strategically to target any type of strategy at this point. Greater shareholder returns, accelerate organic growth, or be aggressive on the acquisition front. All of that is possible. And may I even say, all three can be done simultaneously with this level of profitability.
Yeah, I think that's a point. And that's a theme across all the large producers. Maybe we'll talk about that in a second. Maybe talk about another company specific to us that we follow closely and have owned for a long time and made a lot of money on. Is K92. I know you went through that quarter as well.
In my view, the K92 management team is extremely conservative. They don't like to advertise to the market how beautiful of an asset they have. And I think the hockey stick moment is today or now. They've posted 6 consecutive quarters of free cash flow. 6 consecutive quarters of free cash flow. Remember, this was a story where people didn't believe they could organically fund the phase 3 expansion, which is not an expansion, it's a complete new mill, plus twin declines, plus all the associated required infrastructure, plus a lot of like underground mining fronts being advanced. They've done that a lot of cash flow on a small mine and putting money on the balance sheet for 6 consecutive quarters. Now, Q4 2025, phase 3 starts with the commissioning of the new mill, and that's going to take the throughput through the roof. And you know what happens when you've already spent the capex and your throughput is about to go higher, effectively, with a minor adjustment to the cost base, because the mill operators are the same, roughly. If it's an 800 ton per day mill or a 3,000 ton per day mill, you still need a 1 mill manager, right? Superintendent. So I think these numbers, if you look at the balance sheet and the income statement for K92, is a perfect example of how to run a company very well. But it's not till next year we're going to see like a complete and, may I say, staggering just re-rating of all of these numbers on the higher throughput. And I think at that point is when people are going to realize how, the mighty power that this asset has. And I think that's why we remain invested. We think that the best part's still to come.
Well, I think that's the key point, right? Is that like, even though they've done all this without, having to raise additional capital, they've moved the thing ahead, that it hasn't fully re-rated yet. It's moved with the gold price. It's moved up with good quarters, but it hasn't really fully re-rated to price in that phase 3. And this is always the case with kind of funded expansions. This is why we like this type of investment, is that, you look at something like this and go, okay, this is all funded. The growth is going to go from A to B. We know we have a team that can execute, but the market kind of waits. The market's a little bit lagging. Now, the market will get there sooner rather than later. It's not going to be, probably when the market gets there, they'll be put out Q4 production and they'll put out 2026 guidance. And then, everyone will go, oh, this is what it is, right? And so I think the moment will be in Q1, Q2. But, in the meantime, you've got a really good story that's continuing to execute. So I'm really, investment that's played out really well for us.
To our favorite, I've seen this movie before. I've seen companies with great assets be very conservative in their guidance with the market, because honesty is the right thing to do. It's easier that way. Your re-rating takes longer, but it's more predictable and it's more easily anticipated, which is, I guess, what we're trying to convey here. The re-rating is coming, barring an act of God. It's telegraphed. All the capex, not all of it, but phase 3 capex is all done. A big chunk of phase 4 capex is already sunk. The cash flow needs for this business to continue to grow are minimal relative to the amount of cash flow generation. So we're tipping over that hump where all of the cash flow, or almost all of it, was aggressively redeployed to the point where they're going to start building cash on the balance sheet in a very aggressive fashion next year. And I think people are going to come to realize that this is really genuinely a tier 1 asset with a great management team that doesn't have the valuation they deserve yet. And it will come.
Yeah. And so I think that's That's something we're looking forward to as shareholders. And frankly, this is the other thing that, once you prove that you're generating that much cash flow from that asset, and if it doesn't re-rate fully. In this market, in this environment, this is one of the few single asset producers left out there. That with smaller producers, that probably should be taken out. And so I think that puts the crosshairs right on them.
It does. Yeah.
I guess the other big theme from Q3, and it's something we saw. I mean, it's not unique to Anglo or Agnico or Newmont, but it's all of the producers had either they increased their dividend, bought back, increased the buyback, or claimed to be getting more aggressive with their existing buyback. They paid down debt, and all while being able to fund. And I think that is something that for investors and for generalist investors who are looking at the space, that's part of the little engine that could, right? That's the kind of thing that moves these things ahead. Now, unlike maybe some companies, they can't really ignore growth. They can't ignore investing in CapEx because their assets aren't perpetual. We'll get to that part of sort of what Q3 means to us in a second. But I think from your perspective, as you see those sort of investor-friendly balance sheet activities happening, equity investor-friendly balance sheet activities friendly. What does that mean for sort of generalist investors that are out there, and then how does that change the sort of the paradigm for the large gold producers? Maybe go there.
Number one, there's very few sectors that have today the profitability that this sector has with the valuations that we currently have. Like these are trading like normal businesses. You're not getting credit for the growth. If this was any other type of industry, growth year on year of 50 to 100% with profits, you'd be trading at 30 times earnings or 40 times earnings. Now, it's a cyclical business. We know that those rates of growth are not perpetual or anything like that, but they're certainly they will attract more generalist money. We've talked about this before. As more generalist money gets interested in the space, it sort of displaces, voluntarily displaces, because, specialists in the business like us, we would start trimming holdings on some of these larger names and start redeploying into the smaller producers or even the advanced developers where the valuations are more attractive. And I think what ultimately happens, and what we're expecting, and we've seen this movie before, is these companies end up seeing such great opportunities for growth by purchasing other companies, either producers or developers, using their paper or their cash, because it's immediately accretive to their asset value, or immediately accretive to the bottom line, and it's a natural cycle that happens every time. And we've had a lot of takeouts over the last 12 months, but it still kind of feels like we're just at the beginning of it. The onslaught and the competition for assets has not started yet, and it will come and it will happen. So we have this natural kind of reallocation into the space where we start trimming the winners on the producers and keep kind of like pushing the money down. And frankly, we're not the only ones who do that. Like maybe this is a good time to bring back Prospector, which did a placement with Agnico Eagle, with B2 Gold, and for 19.9% of the shares. That followed up with a secondary or a second private placement that brought in the Discovery Group, not brought to the mint, but like where they reloaded, where a private Peruvian family also invested heavily, and where B2 Gold immediately exercised the right to maintain the 19.9. So now you have an exploration company in Canada with extremely solid supporters, led by a management team that has had tremendous success, and now has something to the tune of $40 million to go into damage next year. And this is why I say that next year we may see a few major discoveries, and here's to hoping that this is one.
That's certainly a key point. But we're also seeing money splashed around elsewhere off corporate balance sheets as well, right? Like that's another big thing, right? These big companies now have spectacular balance sheets. One is burning holes in their pocket, and it's a depleting industry. They all have, maybe with the exception of Agnico Eagle, they probably all need to go buy something. And I think that is to have growth, to grow beyond their current scale. And so I think that's something that we're going to see it. It's going to pick up, and we saw the we kind of come in the last episode. We saw the gold price pull back a little bit, kind of stabilize, and all of a sudden saw probe get taken out. Since then, we've seen new gold get taken out. We've got Goldfields writing a check for $50 million. We've seen this investment in Prospector. I think those are kind of important factors in this as to where we are. We're seeing that need to splash cash around, right? And try and add growth. We haven't, so I expect we'll see more.
And frankly, what we do as investors is try to anticipate that moment, right? We've been in Prospector for years. We were there before B2, and at a significantly lower price. Eventually, you hope that this turns into a takeover, and hundreds of millions to billions of dollars, like was the case for Great Bear. But our view is that our job is to try to anticipate when these things are going to happen, or where these things are going to happen. And I guess we can't end this episode without talking about two of our major holdings that also had news this week. Mainly Arizona Sonoran raising $75 million on a bought deal. No mention on the bought deal about the rights that some of the existing shareholders like Hut Bay and others may have to tag along. So this could end up being a $100 million deal if they do exercise these rights. That's not the full amount that they will need, I think, for the equity portion of this project, but they will certainly take them well into the full bankable feasibility, final investment decision type of framework. Also of importance is that,
and probably cover some of the front. We haven't talked to management, but probably cover some of the front end engineering design, which is also critical when you're going. Feasibility study and investment decision, and then front end engineering are two very different things. And so that it gets them to it allows them to keep advancing the project towards production without having to.
Also of importance is that the neighboring property, which is Ivanhoe Electric, also this week announced a $200 million debt instrument. Effectively with the same purpose. Just make sure you keep the ball rolling fast. You don't have to slow down at any point, because these two assets are well on track for to be built on this cycle. And anyway, we like the location, and we like the management team on Arizona Sonoran, and I'm pretty happy to be there. And
to be fair, the two assets, like the Santa Cruz and Arizona Sonoran's asset, should be probably built together. And so we'll but there's a price for that as an Arizona Sonoran shareholder. And Ivanhoe, I think that we're at this kind of, there aren't a lot of high quality copper assets out there, especially not in North America. And I think that that people are starting to dip their toe in the water in high quality, like looking for those high quality copper assets. And this is kind of that feeling. It isn't quite that, we always talk about sort of 9 figures being generalist money, but we're starting to look at that being the I don't know, this isn't quite 9 figures, but maybe once all said and done it is, but there's probably some generalist money starting to throw money at copper, and that's what you're getting. That's probably what you're seeing here.
Yeah, and where do you start? Best in class, right?
Yeah.
U.S. perfect management team, great location, third side,
but good, better than average.
And we can't end the show without talking about OMI, our largest holding. Derek, you're on the board. There was an exploration announcement. Pretty exciting. Little bit of a wildcat, maybe not wildcat. That's not the right word, but a drill hole that was seeking to prove something, and I think it succeeded.
I'll defer to what Elaine said in her quote, but yeah, the objective was to prove that the structures and the gold continued at depth below the diabase dike and well below the diabase dike, and I think that hole proved it. And I think where it becomes interesting is, and I think people will start to see it when the PEA comes out, but there's significant scale to this project. It has a long mine life already. And then if you add in the fact that this thing might continue at substantial depths, and maybe there's an underground component there afterwards, means that whoever might come in and operate this thing, whether it's us or someone else who wants it more than us, more than OMI, is going to be there for a very, very long time. And that's something I can tell you right now, is that not only is that important for large companies that are looking for assets, but it's also important for the government in the country. They want to see long life opportunities of employment. So it's really is an exciting hole, and I think stocks, well, initially didn't do great on it, has really really rebounded from that announcement.
Awesome. All right.
And I think with that, I want to thank you everybody for tuning in, and we'll look forward to speaking to you next week.